Hi, I'm Jeff Jr., founder and CEO of Trajan Wealth. I'm here to help you turn financial questions into decisions that you feel good about. If you've ever thought, I should probably get serious about this money stuff, or I'm ready for the next step as a seasoned investor, you're exactly who I'm talking to. So with that in mind, let me turn it over to one of my colleagues, Corbett Leduc, a seasoned financial advisor.
I'm Corbett Leduc, Certified Financial Planner, and I'm here to connect the numbers to make sure you have the best retirement possible and the best life that you ever had imagined. I take a long view here. So what we're looking to do is build a plan that's going to give you the lifestyle you want for the next 10, 20, even 30 years. On that, my colleague, Marti Bryant.
Hi, my name is Marti Bryant. I am also a financial advisor here at Trajan Wealth. Work with Corbett. I have over 25 years of experience in the industry. I do hold a designation CDFA, Certified Divorce Financial Analyst. And I really like digging down into what drives and motivates my clients. What are your goals, your hopes, your dreams? How can we help you attain those and get you into and through retirement on the ground that you want it to look like?
So let's get started.
Yeah.
Let's get started. So the intent of the show, 5QIQ, is to take 5 questions from the real audience and increase their IQ. Ooh. So we've got 5 real-world questions.
Awesome.
Are you guys ready for this?
Ready.
All right, let's go.
All right. So the first one is the AI bubble I keep hearing about real? Aren't these companies overvalued?
Overvalued can depend on what you're looking at. So within the financial markets, a lot of times we use baseball analogies. So from an AI bubble standpoint, I think we're in the second inning of this part, maybe even the top of the first. The ability to know that there's going to be winners and losers in this, and especially if you think about 99 to 2000 for context, Cisco, perfect example. Cisco has been dead money for 25 years. So the ability to know that a company like NVIDIA that has had a huge run, are they going to continue to be the dominant leader in the space? More than likely. But other companies will come out, they're only going to push the spectrum of how good AI can be.
But you think we're only in the second inning?
I do.
So in a baseball game, there's 9 innings.
That is correct.
So very early.
Very early.
So they mentioned a bubble. So what do you think of a bubble? So we're far from a bubble.
So from a bubble standpoint, if you think about companies like Amazon in 99 and 2000, books, different things, to change and evolve what AI looks like, the ability to give better answers, better resources, but also to help companies become more efficient and the ability to give better profit margins. That's where AI comes from, but you're going to have to front-load that with a lot of capital infrastructure. So yes, there are a lot of companies spending a ton of money on AI, but the ability to know that they're going to get that ROI down the road. But just like retirement, if you don't do the right things in the beginning, you're not going to have a better outcome if you don't do it.
So what do you think of Zuckerberg pulling back on some of his investments? I mean, he might think it's a bubble, huh?
I don't know if you say it's a bubble, but if you're thinking about where we were 3 years ago with the alternative universe, we're like, oh yeah, I have this virtual farm, I have this virtual house. I mean, really, what does that really mean? It means nothing except for a bunch of teenagers who live in the basements to spend their parents' money on. Because now you don't even hear about that. So the ability to know that, hey, the ability to have, especially the part that's going to be coming up next from after AI, quantum computing, the ability to really put those two together. And that's where I think we're going to see the AI take it to the next level. So that's why I say I don't think we're in a bubble.
So you like it?
I do. Helps make me be smarter.
I still have a banana duct tape to my wall.
That doesn't surprise me a bit.
You think it's a bubble, Marti?
I don't necessarily think it's a bubble. And when you take a look at the companies that we're specifically talking about, so we've got Microsoft, Apple, we've got...
They're more of the fringe players, though, of AI.
Well, not necessarily. So they are involved in AI, and they have a lot of free cash flow. So they're not the ones that are financing the AI portion through taking on debt. Okay, so stick with me on this. So some of the companies, so Microsoft, Meta, Alphabet, they're involved in AI, and developing through their own cash flow. Okay, meaning they're not going out and borrowing money to continue to grow, right? So when you're looking at valuations and you're talking, okay, things are overvalued, you really need to understand fundamentally, what does overvalued mean? Overvalued in relation to what? Is it their ability to continue to generate what they're doing right now? If we look forward, is Microsoft going anywhere in the next 5, 10, 15 years?
No.
Are they going to continue to be able to produce what they're currently producing at the level they are? Most likely. Maybe they'll have a pullback. Maybe they're a little overvalued. Then we look at NVIDIA, right? Some of these companies, or let's use Oracle, for example, because
for a near-term example.
Right, near term. Because until a couple of months ago, or last month, I think it was, is we sold out of our position. And one of the reasons why, Matt Kofina, who happens to be the money manager on those moat portfolios that had it, they were bringing on a whole lot of debt. So Oracle, even though it was up like 81%, he saw that the writing was on the wall. It's time for us to go ahead and get rid of that. And that's a decision that he made on.
Well, absolutely. With the open AI collaboration that they had, Oracle is down 33% over the last 90 days. So the ability to say that, Matt timed that just right, yes. But when you look at the fundamentals that are behind it, it was not going to grow anywhere near what they were talking about.
Correct.
Hence why Oracle has really gotten beat up.
So that's why you really have to understand what you're looking at or talking about when you say something is overvalued. So you can't just straight across the board say AI is overvalued.
Yeah, because if you look at where NVIDIA was 3 years ago, I got lucky. I put in NVIDIA in my kids' education savings accounts, and I am up roughly 1,300% in almost 3 years. 3 years ago, everyone was talking about how overvalued NVIDIA was. So if I listened to the pundits and the clowns on the radio and TV and said, oh, NVIDIA is way too expensive, the PE is out of control, I would have missed out on 1,300% for my kids' college accounts. So now the ability for that to be utilized by me is a blessing that is phenomenal. But knowing that what that company is going to do for the future, sometimes you can't always listen to the noise that's out there.
Well, that's kind of like Palantir and Tesla. There's a lot of optimism in those companies baked in, but they don't really have that foundation like the Microsoft, the Apple, and...
Well, true. Tesla, you're not really buying Tesla for the cars. You're buying for Starlink, the Boring Company.
Right.
All those different things that are out there that are within the Tesla mothership, we'll say. But now it's a matter of saying, okay, are people who own Tesla going to get shares of Starlink? Are they going to get shares of Boring? So speaking of Boring, what else do you think you could do that's not Boring?
So I feel that there is optimism in what people have expectations of those companies doing in the future baked into some of those PE ratios.
But one thing I'd say on the PE ratios too, if you just pay attention to PE ratios, you wouldn't invest in anything right now.
Right.
Because everything's pretty high.
Well, so it's on par. So Microsoft, and I'm going to just those three again, they're on par with the valuations of S&P.
Well, actually, Alphabet's below what the PE is of the overall market. So you could almost argue that, Alphabet is a value company. Debatable. Not likely. They're not paying a dividend. They're still growing 25% plus per year. So the ability to say, yes, hey, they are I think of the Mag 7, they are the best performing of all those 7 companies. And if you would have said, hey, Alphabet's going to be the best performing Mag 7 in January, everybody's like, there's no way. There's no way. Right. Because they're just so big. But guess what? They've been able to focus in, and they're actually making their own artificial intelligence chips compared to NVIDIA. NVIDIA is, the Ferrari for AI chips and the GPUs. Alphabet has come in and said, okay, we don't need to build Ferraris. We're going to build Toyotas. And the ability to know that they're much cheaper, but they're going to do the same job within, I'll say milliseconds of what NVIDIA's chips can do, but same thing. Ferrari and Toyota can get you from point A to point B. It's just a matter of saying, okay, how much is it going to cost me to get from point A to point B?
And you know how much I love my Toyota.
I know.
I've always had a problem with the word bubble, though, too. Just bubble in and of itself. It just paints this dim picture. Like a bubble's just going to blow up and it's going to go away forever. Right. Or like the housing bubble. I'd say it wasn't a bubble. It was more of an expansion and contraction because it didn't blow up. It didn't go away. So I think AI is in the same camp. So
even like back in 1996 when, the market was, it was getting a little wonky. There were people that sold out 2000. It was when that bubble finally burst that everyone was waiting for. The people who got out in 96, the bubble burst in 2000.
Well, irrational exuberance.
But the market did not hit the lows of where it was in 96 when that bubble burst.
Right.
So, the people who might be thinking that we have an AI bubble.
Or the market's too high.
Just be smart about what you're purchasing.
There's a lot more money lost anticipating the crash or losing money than actually gets lost had you just held on to your investments.
Right, just like 2008.
So the consensus here is AI is not in a bubble.
No.
AI is a continued good investment.
So, just correlate it to the technology, where our cell phones are, where, pretty much everything we use every day is. This is a product, either, even though you really can't see, touch, and feel it, it's a product that is continuing to expand and move forward, just like our lives are.
And even if we don't want change, even if we don't like change or uncomfortable with change, AI is part of it.
It's our industrial revolution.
What is it? The ability to utilize that in everything. In fact, I got an email today from my mortgage company, and it had a customized video of what my payment is going to be, where it's from now, how they're going to send me $277 when my escrow comes due in February. And I was like, there's like a 30-second video. I'm like, this is slick. Customized to me, had my loan number, had my name on there and everything. There's no way that
a human is doing it.
Yeah, I mean, that is AI and the ability to, do all those things. But also, the downside of AI is, okay, the jobs are going to be lost from it. That's the
disagree, and I disagree with that.
The jobs aren't going to be lost?
Not to the extent I think that people are assuming. Because AI cannot look somebody in the eye. They cannot feel your heartbeat. They cannot understand your emotions. So there are going to have to be people overseeing AI. There's somebody overseeing the program that, did that slick video for you.
Right.
Right.
Totally.
So there's going to be jobs created in other areas. There is always a job created in other areas.
If those people are willing to upskill themselves.
They're not going to have a choice. What do you think they're going to do? They're just going to be like, oh my God, stick my head up their butt and I'm just going to go slowly. I'm going to jump on the iceberg and float off and die.
So that was an absolutely fantastic segment. I love that. So AI is not in a bubble. We're going to continue to invest in AI.
Absolutely.
Correct. Yep.
Yeah. And
good.
Yeah.
And don't let it scare you. It's part of the economy. It's part of our world that we live in.
Well, and that's where it becomes important. You have a fiduciary, you have a kind of advisory team, like what we have here at Trajan, that you can go to these professionals and ask these questions and get answers, not necessarily like Corbett, but the smart answers that Jeff and I are bringing to the table.
And I think all too often people make just emotional decisions based upon their own emotions and their own opinions and their own feelings. Like, we're going to get into politics here in a second because one of the questions is about the political environment.
Right.
And all too often people make poor emotional decisions based upon just how they feel as opposed to keeping it logical.
And this year's a perfect example of that. If you look at from January to April 4th, how the market went down 19% because of the fear of what tariffs are going to do. Whether you love Trump or hate Trump doesn't really matter. The market misassumed how much impact that's going to have. And if you'd said, I'm out, Trump's an idiot, all the tariffs are going to run the economy into the ground, and you sold out, you have missed out on a huge run from April to where we're at now.
Yep.
Have we stagnated a little bit lately? To a point, but the ability to know that, you have to be looking at the long term. Because if you, just like a roller coaster, if you try and get off in the middle, you're going to get hurt. So the markets can go up and down.
So the next question that we have, we're not going to get political with this one, and we get asked this question quite often with every administration. It's just a different side asking the same question. But this question specifically, Trump is going to run this economy into the ground. What should I do? Should I go a lot more conservative? So let's turn this over to Marti. Marti, what's your perspective on this political question?
Yeah. So first of all, no one president can run our economy into the ground because there's checks and balances. We have policies. We have, different branches of the government that will step in, and we have, debates and pass laws and all of that. So really what the economy is looking at, things that can harm the economy, obviously tariffs, So, but can tariffs also have a positive effect on our economy? So there's two sides. There's two schools of thought to all of it. It just depends on what train of thought you have, right? So some people see the glass half full, some see it half empty. So economic uncertainty. We have our jobs reports that come out, and it looks like our jobs, are reducing. We have slowed growth. So those are things that people look at as a negative, that our economy is being run into the ground.
Right.
But the flip side, there's a positive and negative reaction to everything. So on that side, now we do have revenue generation. We're talking about tariffs, right? So are the tariffs generating positive revenue, however? You'd have to, we could debate or talk about for hours just on the spiderweb effect tax-wise tariffs have. And I'm not talking tax-wise to us. I'm talking about what has that done to our federal economy. Where's that money coming in, and is it being taxed at a different rate? Are we actually truly earning money in through the tariffs, but losing money in another area because of the tariffs? Right? The loss of jobs, potentially because of tariffs. The loss of payrolls. Now we're not paying as much into Social Security. How much do the tariffs really have an impact, and where is that impact being felt? So unless we really sit down and do a dissertation on it, we really aren't going to know until the.
And I think this goes back to our first point with AI too, about the emotion. I mean, if you don't like Trump, you're not going to like any of his policies, and you're going to want to go a little bit more conservative, and you're going to say, I want to take all my money out of the market. Because essentially you're attempting to hurt the situation, right? Same thing happened under Biden, same thing happened under Obama, Bush, Clinton, you go back. I mean, we have the same question frequently anytime a new administration is in. But even if you look back on history, there's been very few, if any, I didn't have an opportunity to look it up, but either of you know how many administrations where the market actually went down during that 4-year term?
I'll find out.
Well, I know from 2009 to where we're at now, we've had 3 down years. 1 year was about less than 1%. We had 2022, which was down tremendously, but we've had a phenomenal rebound since then because of the Fed raising rates to try and get inflation in check. Back to the old adage of buy on rumor, sell on news. Knowing that, hey, if we are going to be cutting rates now, how is that going to benefit the economy and the American consumer into the future? Lower cost of carry, lower mortgage rates, all those different things. But the problem is, for a lot of people, they don't understand is that with the Fed cutting rates, that really has no impact on mortgage rates.
It does not.
So they cut rates. Well, yes, but that has no impact on the mortgage part.
Not immediate.
Not immediate, but the ability to know that, hey, if they're cutting rates, that's going to save you money on if you are carrying credit card balances, interest rates on car loans and things like that. So the ability to know, what are you really looking at?
So when George W. Bush...
Oh, there we go.
So he had recession and then the .com.
And 9/11.
And 9/11. Herbert Hoover. So he was over the,
Good Lord, how long are you going back?
Great Recession, right? And then Hoover was the Great Depression of 1929. But it really is rare that a total market downturn would have happened for 4 years.
So it just goes back to how you feel about the situation.
Right.
You like the person who's in. I don't like the person who's in, so I'm going to sell and go to cash. I like the person who's in. Everything's great. I'm going to make a ton of money. But in reality, both administrations, the market keeps on going up because companies are resilient. Regardless of the administration that's in, companies are going to continue to move forward. They're going to continue to work through the laws and the rules that each administration puts out there.
We can plan for those kinds of risks through our investing. Because we're very specific.
And mitigate those risks with a good diversified portfolio.
Exactly. But the big thing is that we need to express at Trajan is that we're not throwing you into a portfolio of mutual funds. We're not throwing you into a portfolio of just ETFs. So our diversification can come through single stock ownership.
Core has all ETFs.
I know Core does, but that's a choice of the advisor that you're working with. And for some people, it might be appropriate to be in an alt ETF, globally diversified portfolio, which is not something that I personally choose to use. But we can do things differently here, and we do different things here. than what most people are accustomed. The exposure that people have, the first exposure they get in their lifetime is probably through their employer-sponsored plan. It's all mutual funds.
Right.
So they're going to go with what they
Don't even know what they're getting.
They're going to go to Edward Jones and think that, oh, hey, I got something great here, when it's the exact same thing you're already doing. You need to do something different. As companies grow, just like AI, it's growing. You have to grow your money the same way everything else is expanding and growing, and that's not through a mutual fund. You got to get specific and really figure out what you want to own and control your volatility that way.
In a lot of ways, hiring a financial advisor, obviously those here at Trajan Wealth, can really save you from your own bad emotional decisions.
Oh, absolutely.
Because we're not as emotionally attached to your money as you are in some of these bad decisions.
Well,
so that's why it's historically proven that somebody who works with a financial advisor historically will make more money than those who don't.
Right. It's called the Dalbar study. It was done in about 2002. And what they did and found was that if you had worked with a financial advisor, on average, you're going to have a more than 3% better return compared to just doing it on your own, because investing is emotional. The ability to feel like I have to get out, or the emotional part of, the market's so good, I have to put more money into it. No, the ability to find your level of risk that's comfortable and say, hey, I want this for the next, whatever it is, 10, 20, 30 years. And same thing, when you retire, you're not going to die in retirement. You still have to have the ability for your money to grow in retirement, but you have to have the knowledge and comfort level of saying, okay, I'm comfortable with this level of risk, knowing that this bucket of money is meant for 5 years down the road, compared to 5 years now. Yeah, that money needs to be more conservative. That's just a given. But some people don't understand that, and that's where us at Trajan Wealth can add that value and have them understand.
Don't get confused on that. You don't want to be all conservative. Just because you're getting closer, you can't, because you're going to go.
Well, right, and that's why I said you need to have money that's going to be like, okay, this is the money that we're going to use in the next 5 years.
Near term.
Yeah, and then 10 years. And then you got even legacy money. Okay, if you've got $1 million portfolio, let's be honest, you're probably not going to spend that last $100,000. That's going to be money that's going to be for your kids and grandkids. So if you've got that mindset, then we need to invest for their time frame, a 20-year time horizon. So, hey, that last bucket of money, I'm not ever going to use it. But on the flip side of that, if you have not saved enough, then we have to know that, hey, you're going to have the liquidity so that you can have the retirement lifestyle that you want. Just like when you move down to Sarasota, Florida.
That's one thing I think that's a great way to end this segment is the study, the Dalbar study.
Yeah.
By working with a financial advisor, on average, you increased your returns by 3% per year. That's significant. You compound that over 10 years, 20 years,
30
that
years,
is huge, huge dollars.
Yep.
And so what our job here is at Trajan Wealth is, in many cases, to save you from yourself and be your sounding board and let you express your opinions, but allow us to invest those dollars according to what we know is right.
Right.
You're going to come out ahead. So let's move on to question number 3, which is, can you help with Bitcoin? What is the purpose of Bitcoin? And should I be investing into this or not? So who wants to lead this one?
I am a huge fan of Bitcoin for a small allocation within a portfolio.
What's a small allocation?
It's going to depend on what their resources are. I probably wouldn't exceed 1% to 2%.
Okay.
Right? Not right now. Bitcoin is, I look at it, and I think most people do, it's just something that holds value, right? It's just a value place marker. There's a finite amount of Bitcoin. So now we have scarcity.
Right.
We're not going to make any more.
Compared to other coins.
Compared to other investments, any other investments out there.
So if you're a huge fan of Bitcoin, why only 1% to 2%?
Because it's super volatile. It's very, very volatile. When it first came out, it was not correlated to the stock market at all. It was completely an uncorrelated asset. And it was super cool. When my daughter was in high school is when Bitcoin had first come out. And she was attending a school here in Scottsdale. And she came home one day and she said, Mom, this one kid, he just bought a Porsche. And I said, no, you mean his parents bought it for him? And she says, no, he bought it himself because he had Bitcoin. And I just was like, there's no way, and I just kind of ignored it and stuck my head in the sand. And it was the dumbest thing I could have done. But it truly is, I think, we know it's not going anywhere. They're not making any more, but we have to be smart about how we get into it. And it is now correlating to the stock market because people are starting to trade it like it's a stock instead of treating it for exactly what it should be treated as.
Right.
Just something to hold value.
So what do you think? You mentioned uncorrelated. So that means it doesn't act in tandem with the stock market.
Right.
But that's how it was sold initially. But in 2020, it really did act in tandem with the stock market.
It started to.
And people were incredibly disappointed because they looked at it like it was a currency, but it's falling at the same, if not worse rate than the S&P 500.
Right.
Yeah.
What has come to light more is Bitcoin is the leader of the stock market. So if Bitcoin is starting to go down, then the market's going to go down. I don't necessarily believe that, just because, Bitcoin, yes, has limited use capabilities, but also
Right now.
But I'll give you a real world example. My own brother, who had Bitcoin, and he bought $150 for it every single week since 2016, got phished on an email, and he lost $226,000 worth of Bitcoin in a matter of 7 seconds.
Yep. So that was one of my points is, we know this administration likes Bitcoin.
Right.
Because he was targeted and discriminated against by the bank. So that's why they're pushing the Bitcoin. And I think it was a good way for them to get additional votes, especially of the youth, right?
Right.
But what do you think of all the nefarious acts that are happening, the thefts that are happening?
Right. I mean, that can happen too. Like if someone hacks your account, all the different things.
Though.
Not as easily, for sure.
Yeah.
But, he also knew that, the wallet that he had it in, they were going to be changing custodians on it. So when he got this phishing email and he plugged in his safe key, literally within 3 seconds, you watch that $226,000 completely disappear. Now, is that going to happen as a financial advisor firm with a custodian? Highly unlikely. But if it did, the nice part is that those custodians are going to have insurance in place to make sure that, you do get made whole. So, yeah, especially when they talk about, the protections on the account. Bitcoin, there are different ways to protect yourself better, but the same thing. You can still get hacked on an account just like you can with a Bitcoin account.
But again, it's like the changing of technology as everything's growing. It's nothing that you can't 100% avoid the bad actors that are out there. No. It's never going to happen.
Right.
Right. So you just have to, number one, if you are going to be purchasing Bitcoin, why?
Know your risks.
What is your intent for it? Right. What is the purpose? And are you holding it for future? Because Bitcoin's going to continue to evolve just like everything else does.
Right.
Right.
Except for you.
Cro-Magnon man speaks. So the other side of it is there is also the decentralized side.
Right.
Where tokens and Bitcoin can also live. We don't address that. We don't talk about it, but it's there. It's kind of like the dark web. And there is Bitcoin sitting out on that side of the fence as well.
Right. Now within Trajan portfoliows, though, we don't have any Bitcoin.
We don't. It's
Correct.
too speculative.
As far as the company is concerned, we view it as too speculative, right?
Right. It's not truly
too
regulated.
volatile, too risk. Just not ready.
Right. No. And again, there's no, if you want to have a piece of it, we're here for your lifestyle money.
Right.
We're not here for your, hey, I just want a little piece of this, a little piece of that.
Right.
We're going to help your lifestyle. If you're taking too much risk, then you might not be a good fit for us. We're not going to tell you how to spend your money. But if you want to carve off a little piece of that and go into Bitcoin, you're going to be responsible for that asset.
Yeah.
Right.
Because if you truly believe it, then yeah, absolutely. Do that on your own part. And I tell that to clients all the time. Say, hey, we're here to manage this part of it. If you truly like the markets and investing, hey, take a small bit and knock yourself out.
Yeah.
And the ability to know, hey, if that scratches that itch for you, hey, fantastic. But also knowing that, hey, we're not going to take the same kind of risk that you are with this portfolio, because this portfolio is meant to built to last, and know that it's going to continue to grow with a fiduciary on it that's going to have your best interest at heart.
And don't get overcommitted. If you do put a little bit in Bitcoin, don't get overcommitted to it if you made a 100% rate of return or whatever it may be. I've seen clients do that for years. We've been in this industry cumulatively over 100 years.
Yeah.
Right?
Yeah.
God,
so we've seen these clients who don't take our advice.
Right.
They buy 100% of something, whether it's Bitcoin or some speculative technology, AI, whatever it may be.
Yep.
Come out, they put a whole bunch into it. Yeah. They make a whole bunch of money, say, I'm glad I didn't take your advice, Mr. Financial Advisor, because look at how much money I made. But then the next day they're losing a ton of money. But then who are they calling? Us to try to fix that situation. And at that point it's kind of late.
Yeah.
Yep.
So if you're going to invest in Bitcoin, make sure that you're doing it sensibly.
Right.
And you're doing it with a portion of your assets, and you're not doing it with the money that you can't afford to lose.
Right.
Because the money that you're investing with a financial advisor is intended for your long term. It's intended to be there. And there's a certain amount of, I shouldn't say a certain, I'd say in astronomical amount of research that goes into the companies that we're investing and we're buying for you.
Every single day. Every day.
Absolutely.
Yeah.
And one thing I'd say, in closing the segment out here is one thing about Trajan that makes us significantly different than most financial advisors is we don't sub out money management.
Right.
So believe it or not, a lot of financial advisors sub out that work, meaning you work with a financial advisor, you might believe that it's that financial advisor that's actually managing your money, but they're not. And you don't want them to because they're the salesperson. But what they do is they hire another financial advisory group to actually invest your money. And so they sub it out. They're not even doing that work. Here at Trajan, we have it all internal. So that gives us a much better ability to customize our portfolios to really what our beliefs are and any personalization that's needed on your end.
A lot better control. That is not absolutely cool.
Absolutely.
Absolutely.
So in closing, yes, we believe in Bitcoin. Make sure it's sensible. Make sure it's reasonable for your situation. Do it in your own personal account and don't get carried away. Another fantastic segment. So we're moving on to our fourth question. And so the fourth question from our audience is, the market is pretty high right now. Should I consider pulling everything and putting it into cash for 6 months or so?
Oh, absolutely.
Do it.
That sounds
Go
awesome.
for it.
Yeah.
Yeah.
Who doesn't want to make any money?
That is a horrible idea. Horrible idea.
Have a negative real return when you factor in inflation.
Right, right.
What if you could put it in a high yield savings account? So let's give them the benefit of the doubt. Let's say they've got a high yield savings account that's paying 3%.
So you're going broke slowly. You will go broke slowly there. What generally when I hear somebody ask questions like that, that tells me that they probably don't have an advisor. They don't have a long-term plan. They don't have their goals set. The being scared of the market, pulling money in and out, timing of the market.
It's really tough.
And how often do you win when you time the market?
Almost never.
Exactly.
So if you'd sold out and gone to cash in April, when all the noise around tariffs had happened and stayed in cash for 6 months, so say October, you would have missed out on roughly about a 20% rebound.
Well, let's go back to 2008.
Yeah.
So peak to trough to peak again. So all the people and we still hear about this. And it's incredible that people still come into the office and say, I lost everything in 2008. What do you remember what that was? Peak to trough to peak?
Time frame or dollar wise? I mean, percent wise. Time frame, roughly 2 3/4 years.
That's it. So if you'd left your money alone, you were still working. Yep. If you'd left your money alone and continued to contribute into that 401k plan, you would have been exponentially higher right now than for those.
Absolutely. I remember 2008 many times. Having that in mind, what I'd typically tell clients then was turn off the TV, take the dog on a walk. Mm-hmm. It's going to be okay. Do we need this money tomorrow? No. Right. Do we need this money in a month? No. Mm-hmm. It will be okay. I know it feels very dark and dim right now, but it will get better. You just have to know that it will rebound as long as you stay on course.
And most of those people that we're having that conversation with are in their 60s, getting ready to retire now.
Right, but that's also then making sure that you are picking the right level of risk that's comfortable for you. Right. If you were too aggressive in the beginning, well, then let's just take it down a notch. Yeah. Because that's probably the best advice I got from someone back then, and say, hey, look, if you're really concerned about going to cash and everything's going to end, okay, now that's freshwater and firearms. Do you think that we're really at that? No, it's not that bad. Okay, so then let's take a deep breath. If you're really concerned, then let's take 10% off the table. Mm-hmm. Or at least take it down a notch.
Just adjust your asset allocation
if you go from
a little bit.
one extreme to the other, there's no way you can get it right.
Right.
I mean,
and you have to get it right twice.
Right.
When to get out and when to get back in.
Exactly.
Because what's going to change 6 months from now? Right. There's going to be more information out there. There's going to be more time that passed. It's all going to be the same 6 months from now.
Well, and the other thing is be smart about it. Just because there's volatility in the market does not mean that all of those assets went bad.
Right.
Right. So since COVID, there have been 7 stocks. We're just going to focus on the S&P, the 7 Magnificent 7 that were doing all of the swinging of the market.
Right.
People were ignoring the other assets within the S&P. So everyone's jumping on the bandwagon of the highly appreciated ones that are doing all the lifting. Well, you maybe missed opportunities within those other stocks that are still viable to own.
Right, and that's the part that for a lot of people, yes, the market's at a high, but like, oh, now I need to go invest. Okay, well, no, where were you before? And knowing what you're looking at for, but I mean, Charlie Sheen's a great example. He is still relevant. He's not faded. Now, granted, has he made any movie really? Not
But
really.
remember when he made Wall Street and he had that interview and somebody said, hey, what did you learn about the market? Buy high, sell low. And he was dead serious.
Yeah.
He was dead serious all those years ago.
Yeah. And then, but knowing what you're trying to accomplish is going to help you for that. I mean, if you're going to drive from here to Florida and you don't have a map,
right,
that's going to be tough.
But yeah, what you said, Marty, people are still talking about 2008 today. Almost 2 decades later, they're saying, I lost everything. Well, the only way and the only reason that you lost everything is because you did exactly that. You sold at the low when your emotions got the best of you.
Right.
You sold, maybe against your financial advisor's advice. You went to cash and you sat there and you didn't get back in because you were scared. So you really have to time it right. And there's, Warren Buffett said, how many people do you know that have made it rich or gotten rich by investing in the stock market? I rest my case because there's none. So investing is a long-term game. So yes, you just don't want to go to cash because again, you have to time it right. You have to get out at the perfect time. You have to get back in at the perfect time. And your emotions 6 months from now are going to be just as high as they are now. So leave it alone.
Yeah, and that's not to say that we don't rebalance our portfolios in volatility. Right. So like dividend growth a few years ago, when 2022, when interest rates went up, that particular portfolio, the beta, the risk of that portfolio exceeded the risk of what our money manager wanted that particular investment strategy to take. He didn't go all to cash. What he had to do was get that volatility under control, sold 13% of the position, took 13% into cash. He actually went into a short-term yield bond index. I think it was SPY or one of those guys. And then they were slow to deploy the cash again. Right. So we can control that risk for you based upon what our goals are and the rules of each individual portfolio strategy we have for our clients. So we're actively managing that for our clients as well. That way you don't have to worry about, am I going to cash? Am I getting too risky? We're going to handle that for you. That's what you hire us to do.
Being tactical.
Right. Exactly. Being tactical. Yeah, we just don't buy stocks and sit on it and wish for the best.
No, absolutely not.
That didn't work out very well for Sears.
Right. That's right. Or Kodak. Blockbuster. Enron. Yeah, all kinds of them. But nonetheless, agreed. Don't want to go to cash.
Yeah, it's too hard to get right.
And this is again just back to one of the reasons that people make more money by using an advisor is because we prevent or hopefully prevent silly mistakes like this.
And we'll have that open and honest conversation with you. It's not like we're going to say, oh my God, no, you're an idiot. We're going to talk and we're going to walk through it. We want you to be comfortable with what we're doing because if you don't have confidence when you put your head at night, what your money's doing or that you can afford to spend your money, then we're not doing our job.
Right. Wait, I'll tell clients all the time, look, are you losing sleep? Are you having heart palpitations? If those 2 questions come back with yes, then obviously you are in the wrong type of portfolio. We need to scale that back. Right. Scaling back doesn't mean go all to cash, but the ability to say, yeah, this is the level of volatility that I can handle within my portfolio and knowing that, yep, it will go up and down, but for the long term to make sure that we achieve your goals, that's the only way it's going to work. And back to your point with, advisors, it's not just about building the portfolio. Sometimes my job turns into a psychologist. Say, hey, look, it will be okay. With the light at the end of the tunnel is there. I assure you, the ability to know that we have your best interest at heart, because the reality is we just are not going to rebound immediately. You have to know that there's some time that's going along with it. And if we just give up, then it's like running a marathon. If you give up halfway, you're never going to finish it.
In closing, don't go to cash. That's not what you want to do. The advisors here at Trajan Wealth will walk you through and educate. I always say that we have hearts of teachers, and we truly do. So great segment, great question. Thank you for that. So we're moving on to question number 5, and it's all about gold. So the question is, I'm seeing a lot of advertisements about gold, and I heard it was one of the safest investments you could make. So what do you think about moving my portfolio all into gold?
Totally. Makes total sense.
Absolutely.
I sense sarcasm with this one here too.
Hey, go to your dentist and make sure you get a few gold teeth so you can have some gold on you in the event that you need to pay for something.
So the answer to this is no.
No, it's another no. It's another no. Absolutely not.
Now,
why not? It's tangible. It's something you can put in your safe. It's something you can feel. You can put on your kitchen table.
Well, sometimes, unless you're trying to put it into an IRA. If you're buying gold in your IRA, now you're going to have the cost associated with that. You have to have storage. You need to have the TPA, so somebody's going to have to do math for you.
Third-party administrator.
Yep.
For those at home.
There's liquidity risk. So let's say that you just want to stick some gold in your safe. It's not liquid.
Commission risk.
Commission, right? And how do you know what you're getting? So there are, bad actors with everything. So if you're not getting a 99.4% pure bar of gold, then you're not buying what you really want to pay for. And your gold coins should be 22 to 24%, I think is what they recommend of the gold on a coin. So if you're not going to a reputable dealer,
Right.
then
Especially if the coins haven't been graded, things like that.
right, which
'Cause-
all costs money.
Right. But from a standpoint of performance, yeah, gold has done phenomenal for the last 2 years.
Gold's at all-time highs.
Yeah, so it makes sense that now that there's more advertisers because they're getting more traction and questions from it, just like this question here. But if you go back and step back from the forest and look at it and say, what has gold done for the last 20 years? It has underperformed the stock market. Has it outperformed the stock market for the last 2 years? Yeah, sure. But if you even go further, for the last 50 years, gold has dramatically underperformed the S&P 500. To your point, Marty, taxation's not the greatest. Gold, or actually taxes on collectibles, is 28%.
Yep.
So that counters coins. You cannot put coins into an IRA. You have to be pure bullion for that part of it. So there's different things on there. Now, if you want to say put part of your portfolio in gold, I mean, just like anything, if that's something that you truly value, then hey, then a couple of percent is not going to be a huge
10
deal.
to 20% generally.
Right. I mean, at the very most 20%.
Well,
but gold doesn't produce an income.
It doesn't.
And the ability to say, hey, what am I really getting? Because yes, there are ETFs out there that have gold, but same thing. Some hold physical gold. PHYS, ETF that has actual gold. The big one that's out there, GLD of the symbol, actually holds futures contracts. So if we want to go really down the rabbit hole and start looking at different things with correlation, so contango is where the contracts don't match up with the true price of gold. So you take that risk as well compared to, hey, I know what the stocks are at. They get priced daily every second from 9:30 to 4 o'clock Eastern time, where with gold and futures contracts, you don't always have that luxury of knowing exactly, is it matching up the way I want it to?
Or you can take it one step further and go to GDX, which is the Gold Miners Index, and those are the guys that have to mine for the gold.
Right, but it's not even really gold.
It's not, but I prefer that over actual gold.
Why?
And it's an ETF. It's fully liquid because those are the guys that the price movement on GDX, it takes less of a movement on GDX to make a lot of money. So you don't have to use as large of an investment in it to make more money than what your PHX, was it
PHYS.
PHYS is moving.
Right.
So it's going to move.
But then now you're taking on company risk of, hey, if they,
It's all-
let's say if they open up a mine in Nigeria and then the country of Nigeria
it's a
seizes
different
that.
kind of risk, though. But it's a different kind of risk.
But for having gold, there's different things out there.
But typically it's used as a hedge in high inflation,
And geopolitical risk.
geopolitical risk. Yeah.
So what do you say to the people? So we've talked about some of the ETFs, and so what do you say to the people who just like feeling it and seeing it, knowing it's real? Because I'd imagine a lot of people that are buying gold are the people that aren't buying Gold Miners Index or the
Right.
ETFs because they can't see it, taste it, feel it, put it in their hand.
Right.
So what do you say to that type of person?
Don't use lifestyle money on it. Go get the little piece that you want to have.
Costco.
Costco,
Yeah,
yeah.
Costco.
Go carry
Yeah,
it around
no
in your
joke.
pocket if you want to have your pants pulled down because it's so heavy.
So what's the use for it, I guess? That's my view. Is
Peace of mind.
What's the use for having physical gold? When you buy it, you have to pay a commission.
Right.
So it's expensive to buy.
Yep.
Expensive to sell.
Yep.
When you sell it, the reason you're selling it is because you have to buy something else and you have
Right.
to exchange that into dollars.
Right.
So a lot of people say, well, what if the world goes to hell in a handbasket and I've got my gold? Well, what I'd say is, what are you going to do with that gold?
Right. I mean, if it really gets to the point of where it's like, like I said, freshwater and firearms. If that's really where you think the world is headed, yeah, gold is meaningless.
Right.
You have to be able to eat and drink. So if you're on that level of fear, gold is an afterthought because it doesn't really matter. Can't eat it, doesn't produce an income, and knowing what you're really trying to accomplish. Yes, I can trade gold for goods, true, but if the world is really at that level,
It's
it doesn't
mayhem.
really matter.
Yeah. It's Mad Max times.
Oh, man.
Why don't you hear all this about diamonds? Why isn't diamonds treated like gold? Is it just because we used to be on the gold standard?
I mean, I think part of
diamonds
it-
have.
Well, diamonds have gotten crushed
Right.
over the last 5 years.
But also the reputation of mining diamonds.
Right. Blood diamonds and things
Right,
like that.
things
So
like that. There's a lot of-
that's not only say stigma, but the reality of that is that do you really know what happened to get that? Now you could do the same thing with gold. You know, all those different things, because I can assure you out in Nigeria and different parts of Malaysia, it's not all safety up to code, things
No,
like
it's
that.
not. If you really need to have that peace of mind, to have it in your safe or sitting around somewhere, do that. But by no means should it represent more than 20% max of,
And as far as Trajan Wealth, we don't have any
We don't.
gold in our portfolios.
we don't, because it's
It's not an income producing.
it's lack of
really-
diversification.
Right.
You know, it's just, it doesn't fit into what we're trying to accomplish with our clients. It holds value, not unlike Bitcoin, right? Bitcoin, it's a value play. This should just be something that's going to hold some value. If we really look when gold started on this tear, it was when we couldn't balance our budget. Remember, it's December, January, a couple of years ago, we couldn't get our heads out of our butts to figure out what we're doing in this country.
Right.
So instead of people continuing to invest in the dollar, so that's when the dollar started devaluing, we're still the world's reserve currency. We are the reserve currency all over the world, but we were unstable, so people started turning to gold. Right. And that's when they started, and that's when we started seeing gold creeping up, right, is when we couldn't get our act together. So it was a hedge against the geopolitical risk, the dollar devaluing, we're just going to go sit in gold for a while. And I think that's really what started this trend of gold hitting
And then
its
once that
all-time highs.
momentum kind of just starts,
Yep.
it's really kind of hard to stop it, because
Yeah.
then once, especially when it crossed 3,000, boom, you know, it went from 3,000 to 4,000 in short order, because at that point there's no sellers left. You know, anybody who wanted to
No.
sell gold are gone.
So any predictions on what's going to happen with gold
Up
as
and
far
down.
as the price?
Up and down.
Say
It's going to go up and down. Yeah, I agree.
Yeah, fair.
We finally agree on something. Yay.
It's going to go up and down like anything else, but look at the historical track record, doesn't nearly perform as well as
Yeah.
the stock
No,
market.
and what are your goals in life? Like, really,
Right.
figure
So
out
just-
what you need.
Right. Take a look at what you want, what you're investing for.
Right.
Yeah.
If you're investing to make money, I'd much rather do it with companies in the United States than a physical.
Right, and it's much easier to convert to dollars compared to,
Right.
oh, I got to take this
Right.
bag of coins
Doesn't
down
cost
to the
anything
pawn
to
shop or
convert it
something.
to dollars.
Right.
When you take your bag of coins in, you never know what kind of commission you're going to pay or
Right.
upcharge or markup, et cetera. So,
Right.
yeah, as far as gold is concerned,
A small piece.
a very small piece. Exactly right. So thank you again for joining us on 5Q IQ, Financial Power-Ups with Trajan Wealth. If you found value in our talk, we'd love for you to share it with someone who might also appreciate it. Have a question yourself? Whether you're just starting out or planning for the future, send it our way at trajanwealth.com/5QIQ. We're standing by to help you plan smarter and dream bigger, however many questions you might have. We'll see you next week.